Hello everyone, I'm Paul Washington, Executive Director of the ESG Center here at the Conference Board. The ESG Center focuses on issues of corporate governance, sustainability, and citizenship. I'm really delighted to welcome you to the latest edition of Governance Watch, our webcast series that we co-host in collaboration with the law firm of Cleary, Gottlieb, Steen, and Hamilton. Today we're going to be talking about M&A transactions, what boards and advisors need to know. And we're going to be focusing on a few key issues, including internal forecasts, the rules and responsibilities of insiders, and assuming that we've got time, the emerging phenomenon of fundless sponsors. I'm really thrilled to be delighted by 4 experts who are going to share their insights with us. We're joined today by Anu Iyengar, who is head of JP Morgan's North American M&A group, responsible for the marketing and execution of advisory agreements in North America. Welcome, Anu, from London.
Hello, happy to be here.
Delighted to have you. We also have Tony Kim, who is a partner at Centerview Partners, an independent investment banking and private equity firm.
Thank you for having me.
Great. And Ethan Klingsberg, a partner at Cleary Gottlieb.
Thanks, great to be here.
Glad to have you. And Jim Langston, also a partner at Cleary Gottlieb.
Thanks, Paul.
Great. So before we get underway, I have a few housekeeping notes to cover, so please bear with me. First, we are offering both CPE and New York State CLE credit for participating in today's live program. To get either credit, you need to stay online for the entire webcast. For those of you who want CPE credit, you need to enter your full name, email address, and specify CPE in the Request CPE credit space at the bottom of your screen. Please note that 3 pop-up messages will occur during the program to confirm your participation. Please click OK each time you see one of those prompts. For CLE credit for our lawyers, you need to download the CLE verification and CLE evaluation forms posted in the download section at the bottom of your screen. Please complete them and email them to our friends at Cleary Gottlieb at the email address provided on the forms. I will provide a verification code later in the webcast, which you will need to write into the forms to get CLE credit. Second, I really want to underscore that we welcome questions today from the audience. We look forward to your participation. You can ask questions at any time by entering them in the chat box at the bottom left of your screen. We'll work them into the conversation as best as possible, and if we aren't able to get to them during the live webcast today, we'll send out answers to the participants later on. Finally, a few other housekeeping notes. Cleary has provided some background materials that go more in depth into the topics we'll be covering today, and you can download the document in the download section at the bottom of your screen. In addition, as part of the slide deck for today's webcast, we have offered a link to a terrific report issued by our Human Capital Management Center. It's available to members of the Conference Board. It's entitled The Leadership Factor in M&A. I mean, we all know that deals can sound great in concept, but fall apart in practice. And this report provides really practical insights into how to lead a team both during the planning of a deal, due diligence, all the way through execution. A technical note, you can enlarge the video to full screen view by clicking on the 4 arrows in the upper right-hand corner of your screen. Finally, we'd ask that you please complete the evaluation form. This is separate from the CLE evaluation form at the end of today's session so we can incorporate your feedback into future webcasts. And now, with that really difficult part out of the way, I'd like to turn over to our discussion and to our panelists. So, Ethan, let's talk about internal forecasts, which is a hot topic. Sort of to set a baseline for the audience, what is the role in forecasts in the context of an M&A transaction? How are forecasts used by the various players, and how do they get into the hands of shareholders?
Right. Well, forecasts is in one way is the most critical, from one perspective, is the most critical element of any M&A assessment. Because what the board's doing is the board is trying to sit there and figure out whether this is of a target. This is the right time to sell, and if they're going to proceed with the sale, are they getting a fair price? Are they getting an adequate price? And there's lots of analysis that comes in from Tony and Anu, And all of that analysis stands on the foundation of the forecast. Now,
and it's management's internal forecast.
And these are management's internal forecasts, right? I'm not talking about the street numbers, which are out there for everybody. So if you go back like 12, 15 years, it was kind of a sleepy process because no one really had much visibility into the management forecasts as from an investor perspective, and they saw the street numbers, and sometimes they get some visibility about what the financial analysis was. Maybe you could reverse engineer what happened. But what's happened over the last several years is there's been an explosion in disclosure. So first it started in Delaware, where the Delaware court said, hey, this is kind of material. And we should see, those shareholders before voting should see the forecasts that were given to the financial advisor so that they can really understand their financial analysis. And then the SEC jumped on that and started asking for forecasts in their comments. Then the plaintiffs started asking for forecasts when they would when they would conduct discovery, challenging the deal. And then it got even more interesting because we started seeing disclosure of forecasts, multiple forecasts. You see, well, we gave this forecast to the bidder, we had this forecast internally, then we used this forecast, we upgraded our forecast, we changed our forecast. And all of this emerged at a time when you had more and more pressure on companies to do M&A because they're accretive from shareholders, more consultants in the boardroom coming up with alternative inspirations for different sets of forecasts, more variables out there ranging from tariffs to tax code changes that all impact forecasts. But most importantly, the plaintiffs started seizing on this idea that, if the forecasts change, that changes the whole acceptability of the takeover proposal. And maybe we should look at what's going on there. Is this being manipulated? What's the basis for this change? And really getting into the weeds on that front. And that has led to an intense focus on getting this area right. And it's pressure on management, it's pressure on the financial advisors, and it's pressure on the legal advisors, all having to work together to create a record of integrity when it comes to the forecast.
Got it. Great. And we'll delve into some of the legal risks and other practical things that boards and managements can do to deal with this issue. But before we get into multiple forecasts, let's look at the opposite end of the spectrum. What if a company doesn't have a current internal forecast? When can that arise, and what does a company do about it?
So oftentimes a company will have a one-year budget. That's usually pretty common, but that may have been done a year ago to 1 month ago at the time that you are looking at it. But for decision-making of the type that Ethan just described, when a board is trying to evaluate and say, should I pursue strategic alternatives or not? Should I pursue a sale or not? Should I pursue a minority investment or not? You may require a longer set of projections. Sometimes that's 3 years, sometimes that's 5 years. Now, there's one thing all of us can agree on, right? There's no perfect crystal ball which tells you exactly what your EPS number is going to be 5 years from now. So by definition, whatever forecast you're going to come up with is going to be wrong in terms of being precise. But on the other side, I think the intention behind all of this is to come up with a reasonable estimate so that the board can make a reasonable decision on the basis of that. But where the problem comes in is sometimes this is not a board-initiated process. So this could be reactive to either an activist coming in, or reactive to an event, reactive to an approach that they have received from a buyer, or reactive to some other situation that has happened in the market with a competitor or something like that. And you may be caught off guard with the fact that you don't have a set of projections. And frankly, that's one of the reasons you end up with multiple projections, because then the management of the company very quickly comes up with something, and with time and thought refines it to something that is gets better or more granular over time. There's also the natural tension between what do you want to show as your best foot forward in a sale process to a potential buyer or investor versus the most likely reasonable case adjusted for upside and downside that a board should rely on when you're making decisions. So some of it is timing and evolution. Some of it is a natural tension that exists between, in some ways, the purpose of the forecast. But I agree with Ethan that this topic has become more front and center, really driven by disclosure and litigation.
Right. And sorry.
Paul, I was just going to add that it's a situation, this particular situation of projections being stale that seems to come up more and more often these days. Part of it's because there's a dynamically changing world. And I would just reiterate what I think Ethan said, that you really need to have the best available numbers for the board to judge. And so the standard really is the management team really has to feel they're up to date. If they are out of date, even if they're 2 months old, it's not okay to just use those. It's not okay to just hand those over to your financial advisors and say, just run the numbers on that. You need to be giving the board the best possible judgment at the time of the transaction.
So let me ask you, so is it realistic for a company that thinks it might be under, in a situation where a bidder could show up or a buyer could show up to, periodically update their forecasts throughout the year? I mean, that's a lot. That's a big burden on management to do. I'm just wondering if you get someone showing up and there's a time limit in responding, you don't have an up-to-date forecast, and you don't want to wind up with a situation that Anu is talking about of having multiple, going from no updated ones to having multiple ones, over time.
Right.
What should a company do?
So I don't think anybody would suggest to kind of keep your forecasts regularly updated in anticipation of something. It's really when a situation arises, you're going to know the time frame that you have to respond, and you've got to exercise your best reasonable judgment during that time with the best available information. So, obviously, if you had a year, you could do a giant strategic review process again. But if you have 2 weeks, you got to go with what you have. The important thing that I often encounter is folks who are saying, well, these numbers are a little bit stale, but we can use them, as opposed to they're a little bit stale and we should take our latest flash numbers, our latest view on the markets, and we should update them with the best judgments that we can come up with.
Got it.
I mean, I would emphasize that it's worth taking your time. And it's perfectly legitimate to say to if either an activist or someone who sends a letter, it's going to take us a month and a half, 2 months. It takes time to build a model, especially for a company that has many pieces, lots of different risks, and it's really worth taking your time on that initial modeling process and not to scramble like crazy. I mean, it's advisable in my eyes for management always to be thinking that they may have to take their 1 year budget and turn it into something that's really represents their best good faith vision of what's most likely to happen over that year. And maybe there's some tweaks to the budget, and also understand how they would build it out to 3 years and even 5 years. I think that it's advisable for management always to have that in the back of their head and figure out what they would have to do to get there.
And frankly, as a matter of good governance, it's frankly good to give your board more than just, you may have a 1 year budget, but you ought to, I think a best practice is to have a long-term plan in the context of long-term plan. Makes it much easier to update if you need to. And frankly, does the board a service in letting them know what the overall trajectory is over time.
Right.
So,
And for those internal purposes, there's going to be, commodity prices may change. There's a lot of macro factors that you're not able to control, and that's completely fair and actually advisable to explain to your board, here's the assumptions, right? And here's how we got to those assumptions. And there's going to be, what's interesting, it should be an interactive process with the directors, because there's going to be some directors who say, you know what, I think that you should do it a different way, and let's build in a sensitivity that shows exchange rates going in a different direction. And then there's contingencies which haven't really been thought through, but could provide upside or downside. Maybe we do this M&A deal that's in the pipeline, and that'll change, that'll give us a lot more upside. So all of that has to be fleshed out, and that should be part of the deep dive that boards do at least annually with management.
Right, and it's an iterative process, right? And it's best for that process that Ethan just described to be in the record, right? Because ultimately this is all about the record and the process that the board followed, and it's not enough for the board to just follow that process. It has to make its way into the board minutes as well. So that's something that folks should focus on as well.
Keep in mind, yes. So we've touched on it, and
But that's sorry, I was just going to say that's an interesting point that right now the public perception, or at least in the litigation context, the projections not changing at all is like a good thing. And whenever the projections change, people view that with a suspicious eye. Whereas I think the better process is debates with the board, and if there are consultants, and a refinement of it, and taking the time to do that. And if the projections do evolve, that should be a good thing, especially if they evolved because of discussion.
Right.
If they evolve to get to the right answer or whatever, that's a different matter. But if, most of the time they evolve because of good discussion and back and forth, or something's happened in the market that you have to factor in. And that's a good thing.
Right. I think the problem is sometimes they're evolving because they just, the blocking and tackling isn't done up front.
Right.
So you have something, you're not really paying attention. The bidders, when they're doing their evaluation, they're putting a ton of work in. And then all of a sudden the bids come in and there's a disconnect between your football field that you grew out of your forecasts and the bids. And management says, of course the bids came in here because there's all these assumptions that we have which are completely unrealistic. And our real forecast should be here. And you're like, oh guys, thanks for telling us now. Right. And so that
you have to have the ground rules up front, right? To have your arms around what projections are out there.
Right.
And then as they evolve to reflect that debate and discussion that Anu and Ethan have been talking about, to have that, right, that's in the record, and that folks are aware of, and to understand the implications of what it's going to mean, because if there is a transaction, there's going to be a proxy statement, and you're going to have the question of what projections end up getting disclosed, and so it's important for upfront to everyone to realize what those implications may be.
So I have a question for Tony. Like, for instance, how do you prevent that from happening? Because you see those projections from the beginning.
Yeah.
So when you guys are diligencing or evaluating the model, you're saying, it's yours, it's not mine.
Yeah.
But isn't there a point where sometimes you say, guys?
I agree with what you said before in that you've got to be diligent up front. You've got to do your homework and your blocking and tackling. When a management team hands over a set of projections, the investment bank should never just turn around and spit out, well, here's our valuation of that. You need to work with the management team. You need to test the assumptions. You need to say, well, how do you feel about this particular trend that you're seeing versus that? And get a sense of exactly what it said. Is this baked in with a bunch of things that are just hope, or is this a rock solid, 90% achievable plan? And provide some feedback to the board on what you're seeing. And I personally think, again, assuming there's time, going through that process and having that discussion with the board before settling on, well, this is a set of projections that the management team and the board believes in, goes a long way to avoiding that, oh, whoops, we had to change things by 20% because we didn't think about something 3 months into the process.
It's hard to unring the bell at that point. And before you get there, you can always provide the board and the management with some views based on public information and street estimates.
But it does sound like it's interesting because the common wisdom has been you just want one forecast and that's it, and it's our story and we're sticking to it. But what I'm hearing is that you want to do the best job possible up front, but actually it is okay if there is some degree of iteration over time in response to board discussion and so forth in refining that forecast.
I think that's right. Multiple forecasts are not a crime.
It's not a crime. But let's talk about the legal risks, Jim, if we could, associated with having multiple forecasts, whether they occur sort of seriatim or simultaneously.
I think we've talked about the two principal legal risks. One is disclosure and one is shareholder litigation, right? We talked about having multiple forecasts. You get to the proxy statement to prepare that and mail it to shareholders, and the question is, what ends up getting disclosed in that proxy statement? Most of the law that's developed in this area has been in Delaware. And the courts there haven't drawn a lot of bright line rules. What they have focused on is and recognized is that, as I said earlier, it's an iterative process. And most well-advised boards are just trying, and management teams are just trying to get to the right place and coming up with a forecast that they're comfortable with and stand behind and represents their best estimates. And it's not just the case that because it gets reviewed or used or shared with some party, that in and of itself triggers disclosure. They've also recognized that it's not always the case that more information is better, right? If you have a forecast, to use one of the examples we talked about earlier, that was stale, no longer reliable, that providing that information to shareholders could actually do more harm than good, right? Because it could be misleading and it doesn't reflect the business realities today. So that's how the Delaware courts look at it holistically. And two of the guideposts that we use is, one, if it's disclosed to the board and it's used by the board, relied on by the board, and it's used by the financial advisors, that's something that's going to get disclosed. And also, if there are other versions of the forecast that are used by key participants in the process at some critical juncture of the process to make decisions one way or another, it's likely that those are going to be disclosed as well. So a lot of times the risk and the problems comes up when companies get it wrong, when they don't disclose projections that the court, with the benefit of hindsight, feels it should have been disclosed, and then that leads them to, as Anu said, question the motives of the board and the management and wondering whether or not they would do the right thing. We also talked about the increase in shareholder litigation, or the risk of shareholder litigation that the multiple forecasts present, and that just allows the plaintiff's bar to develop a theory of the case, right? Either that the board was waffling on value, that it's a sign of a poor process, or even worse, that it was used to justify a deal price that really wasn't as good as it looks. The other risk that we see in this area, one, was around appraisal proceedings. You had multiple forecasts floating around that could be used in those proceedings to push for a higher appraisal value. Those risks, I think, are a lot lower today because of some of the developments in the appraisal jurisprudence in Delaware. And the other one was, if you have multiple sets of forecasts, which of those get disclosed to the buyer? You have a set that you've been used up front to marketing the business. Later, there's the board and the management team come to a different view on value, and there's a lower forecast. Do you need to disclose that to the buyer? And what are the legal and reputational risks from not doing so?
Because you could have a lawsuit for fraud or something like that
Exactly.
afterwards, right? Yeah, I mean, I think of this a little bit in the context of antitrust law, that it's actually good to have the same story that you're telling to everyone. And frankly, the lead story is the story you're telling to your board. And then that's what you also tell the bidder. It's also what you tell your shareholders, and because it may be the story you need to tell the Department of Justice or whoever else may be dealing with the deal. It's
or
really
that
good.
bidder is telling to its lenders.
Yeah.
And there's,
and your
federal
lenders,
banking
right,
law
yeah.
that says you can't provide
misleading information
to the banks.
Yeah.
And you're facilitating that as the target or something if you're giving the wrong
So
estimates.
what's
So
true
it's-
for your narrative of your rationale for doing the deal also applies to...
There's lots of unintended, unexpected trip-ups that can happen along the way.
Exactly.
But different companies also have different ethos in terms of how they do the projections. Because sometimes companies always do stretch plans, and if you look at it historically, their track record of actually hitting their projections is not high, and that's just culturally what they do, because they give stretch plans to all their divisions, and that's what rolls up. So again, there's nothing wrong with that, because that is their cultural ethos, and when people do due diligence on it, they understand it. So one of the questions we often ask, either on the sell side or the buy side to the management teams is, one, what is the kind of underlying macroeconomic assumptions that you've assumed, especially at a point of time like today, depending upon how global the business is or regional the business is. What have you assumed in terms of recession risk? What have you assumed in terms of currency? Because those things can move it up or down, and you can have a lot of sensitivities with the different scenarios around it. And likewise, you could also say, do you think this is a plan in which you have a 75% or very high confidence level, or would you say that has equal probability of being higher or lower? Like it's a 50-50 confidence level. And different boards, different management teams have different criteria for how to think about this. Sometimes it is the plan on which you're going to compensate the management team, at least for 1 year. And those metrics would be pretty relevant. So part of the downside of this intense focus on having one set of projections and a static set of projections, which is somehow considered to be good, is you lose the richness, the context, the evolution, and the natural cadence of each company on how these projections come to be. And that's not a good thing. So we should find a way to retain that, because that is each company has its own style, and we shouldn't lose that.
That's really helpful. Although, if a company is always doing stretch targets and they're always missing it, you may not actually be doing a great service to your board in providing them with those targets over and over again, because they may actually want to have a sense of, okay, but what can you actually achieve? It also makes the story a little harder to tell to your shareholders, to tell to your various other constituencies. So at least in the compensation context, one thing you can do is you have your plan, but then you give extra if they achieve their stretch targets under your bonus plan. So you actually base your compensation plan on achieving budget, but you can provide extra incentives for exceeding it. That may at least help simplify the story for the board and for other constituencies.
Yeah, or that's why oftentimes you end up with two cases, is because you have that stretch plan, which you want people to aspire to. And then you're absolutely right. The board makes its decisions based on a realistic plan. And so, where you started,
exactly.
That's one of the reasons you have these multiple forecasts.
Right. But good to label things as such too, by the
Absolutely.
way, whether dealing with the board and make it clear whether this forecast is used for this particular purpose or this plan is used for this.
I think that's
And
really
explaining
important.
it that way to your shareholders.
Yeah.
Because that's what the plaintiffs will seize on,
Right.
right? And if it's
Right.
not clear, that ambiguity,
Yes.
then they start
Then they would
creating
just-
stories.
Exactly right.
Also, timing is important, because if you're fixing the story too late in the game,
Right.
it becomes harder to make it.
I think
stand
that's
on its
right.
own.
So, for example, if a deal drags on or something like that and you need to renew the forecasts, it's probably not a bad idea to give an indication to your board along the way that we're either facing these headwinds or these tailwinds or whatever the story may be, so that they get a sense of what may be coming down the pike. So it's not associated with, hey, we're trying to hit this particular number in our forecast to justify our ultimate decision. So Tony, let me just ask you this. So the issue of multiple forecasts is coming up more and more these days. So
Absolutely.
why is that? What are the underlying dynamics driving that?
So I think there are really three things that are driving it. Number one is, with the focus on governance, boards are more active and they're asking more questions. And, three questions may come up and the management team may feel a need to come back and say, well, if that were to happen, this is what would happen to our projections. I see a lot of that. The second one is just what Anu said, which is, it's an uncertain macro environment, and you're just a pin drop away from having a very different economic backdrop against which you have to factor in what happens to so many businesses. And the last one, which I think is really important, it's the theme that you see across all industries. For the past several years, there's tons of disruption going on, and so businesses that used to be kind of sleepy and just kind of hit their numbers every year or came within 2% up or down, they're running cases where, wow, well, it's down 10% this year, or if this new initiative succeeds, we're going to be up 10%. And so you almost, by necessity, can't have a single case that you're talking about internally. I think that, one of the ways people try to handle that is with kind of a base plan with sensitivities,
Right.
and talk about things that way. But, what I'm seeing with management teams and boardrooms is a much more robust discussion around the uncertainties, which I think ultimately is quite a good thing in terms of managing these companies. It creates, as we're talking about now, a lot of complexity when you end up in an M&A situation, though.
Got it. That's really helpful.
I agree with everything Tony said. I think there's also a legal reason to it.
Yeah.
About 5 years ago, there was this case called Corwin. It came out with this principle that in transactions that don't involve a controlling shareholder, a fully informed, uncoerced shareholder vote has a cleansing effect. So it cures a lot of any imperfections and defects in the process, so long as it was fully disclosed up front. That meant that it was very difficult to challenge M&A transactions in Delaware, right, to bring litigation, trying to disrupt those transactions. And so I think as a result, you've seen companies and advisors be more careful about what they're disclosing up front. And because the projections is really core to the transaction, the story, and whether or not now's the right time to sell, and if so, for what price, I think people are paying greater attention to the disclosure of projections and the consequences of not disclosing. And then on the other side, because it's become so difficult for plaintiffs to challenge transactions, the one way they can do it is showing that the vote wasn't fully informed. So there was some sort of disclosure inadequacy. And one of the most important pieces of disclosure is projections, right? So they're focusing on this as well.
Okay, that's really helpful. And look, I know we've already touched on this a fair amount of how you deal with multiple forecasts, that you sort of make clear in the record why you're updating it. You try to get your best shot in at the outset, and so forth. Also, frankly, highlighting some of the uncertainties is also probably helpful, both with your board and with your shareholders, to give yourself a little room. Any other practical advice that you have for our audience as to how to deal with multiple forecasts that help you serve the board and the shareholders while mitigating your legal risks?
I mean, I think, there's one issue where we're talking about, what I call blocking and tackling, right?
Yeah.
Figuring out what are the different purposes, getting to what you think is the best case. Sometimes you end up in a situation where it's just, could go this way, it could go that way. And so you can engage in what we call probability weighting, right? And just take the different cases and probability weight them. And that is one way of reconciling what seems like an irreconcilable process. The other is really, frankly, just pressuring, saying, you got to come up with the best view of the future. And if they can't do that, and making that clear from the get-go and working that out up front. But that's other than that, just having two cases out there and saying, well, I don't really know, is really not you're not doing your board any service.
Right, so if you've got, here's the baseline case, here's the upside scenario, here's the downside scenario, and you're not giving any sense on what you actually think is most likely, is not actually doing a service to your board or to your shareholders, or to the litigators who are going to have to defend you.
I mean, it's great to have the sensitivity spelled out, and I agree with Anu. You're fooling yourself if you're just being rigid, and not showing those sensitivities. But at some point,
you have to settle on one.
You need some analysis, right? And so this probability weighting is sort of a last resort.
I'll just add a point to that. So I think that in an ideal world, you're going to land on a single case which reflects the management's best judgments. And then you have a series of sensitivities to take into account the landscape of ups and downs from there. You will sometimes run into a situation where the company has been talking to its board about multiple cases, let's call it two cases, an upside and a base case, for a long time. And I think what you're going to find yourself in the position of is either having to explain why we're no longer considering the upside case, and now we're only considering the base case, and I think that should be part of the board discourse and record.
Absolutely.
Or you're going to have financial advisors who are going to have to look at both of those cases, and then add on the color, and the management can speak, and the board can kind of express its judgments. But as companies in the ordinary course are thinking about projections with a view towards if an M&A transaction comes up, the context of how those projections have been discussed historically, and then the context of how that migrates to what you ultimately present to your board in that first instance where you're actually discussing a deal, is really important, and it doesn't go away. It has to be explained all the way through.
Right, I think that's a really critical point, and it's very good to explain those dynamics well in advance of getting any kind of bidder who shows up, right?
That's right.
So that it's there, that it's clear you're not just manufacturing this to deal with this particular situation.
Right, because I think that ultimately is the primary, angle of folks who are coming after folks in litigation, and regardless of whether it's true, can they allege? And that's why so much of it is just making sure you're thoughtful and concrete in why you're doing what you're doing along the way.
Great. So let's shift gears a little bit. Oh, sorry, Anu, go ahead.
I was going to say, sometimes people also lay this out as, here is my base plan, and I have 5 initiatives. and you kind of go through, here is each of the initiatives. Chances of all 5 being successful, probably unrealistic, right? You need every sun and the moon and the stars to align. And so then boards will also say, okay, let's assume that either each initiative has a 50% probability of success, or 50% of the initiatives have a 100% probability of success, or something like that, where you layer in each of the initiatives, because that is how the company built the plan.
Right.
That's another thing I've seen with a lot of companies as well, where you take the upside plan and you break it down into its components. Say, what's different from the base plan? And I'm going to give credit to some of it, but not all of it. It does require the board to exercise a lot of judgment around it, but again, it's reasonable and informed judgment.
And thank you. And you may not actually want to put an exact percentage of probability associated with it, because you don't actually necessarily want to have someone do the math and say, okay, well, this all adds up to that, and this is the number you should have used. I think preserving the fact that this is the board's judgment and management's judgment, whether it's a high, medium, low risk or something like that, or just outlining it, can give you a little extra flexibility down the road. So let's shift over a little bit to talk about insiders. Okay.
Sure.
And so, Jim, there's been a lot of focus by the Delaware courts on the role of insiders in M&A. Can you just give our folks who are watching a little bit of a background of the evolution of the case law in this area?
So a lot of the case law developments in Delaware the last 10, 15 years have focused on insiders and conflicts of interest. So situations where a fiduciary or some other key player in the M&A process acts for reasons that are in their own self-interest and not doing what's best for the company of its shareholders. The types of conflicts of interest in those cases have come in all shapes and sizes. Some of them have been obvious, right? So like the controlling shareholder who's on both sides of the transaction is trying to take the company private and cash out the minority shareholders. But other of the conflict of interest situations have been not as stark, right? So you have the strong-willed CEO who's the lead negotiator for the target company. His future at the combined company is uncertain. And so at the time he's negotiating the deal price and the other key deal terms, he secures a commitment for himself as to his post-closing employment and what the terms of those arrangements are. Or you have a private equity bidder. Right? So as part of the initial approach, they show up, they talk to management, and they try to entice management with equity rollovers and other goodies. So those are the types of conflicts and situations that the courts have dealt with. And one of the developments has been that the court not just focusing on the behavior of the conflicted fiduciaries, but also looking at the independent directors and the rest of the board and looking at their conduct and examining what they did and whether or not it was sufficient to discharge their fiduciary duties in those situations. And the things that the courts have looked for is that, was the board being active? Was it supervising the process? Was it supervising management and the other advisors? Were they attuned to conflicts of interest? That's something the board was focused on. And then if a conflict of interest did arise, what did the board do? Right? Did they just try to sweep it under the rug, pretend it didn't exist and hope no one would notice? Or did they think hard about it? Did they take steps to mitigate the conflict of interest and try to prevent the conflict from tainting the process? So that's a little bit different than the historical focus and has led to some practice developments in this area as well. I think the other key development was this idea that in a controlling shareholder transaction where, as I said earlier, they're trying to take the company private, that there are steps that the controlling shareholder can take at the outset, if it wants, to avoid entire fairness review, which is the highest standard of judicial review in Delaware, and instead get business judgment role. If at the outset of the transaction it was willing to agree that it wouldn't proceed unless a special committee approved the deal and a majority of the minority shareholders approved the deal. And that was an important development because before then there was really no way to get those cases to dismiss in an early stage on a motion to dismiss. It was very hard to do that.
So that mechanism is now there.
Exactly. So that mechanism down there. It's not a perfect fit for every transaction. Then we're going to talk about how the majority of the minority condition can introduce some execution risk to the transaction. And so there is a path to business judgmental deference, but it can come at a cost.
So let me just pick up on one of your examples there, which is the strong-willed CEO, whether he or she is negotiating the deal and is looking out for him or herself in terms of the deal terms to provide either a role or some particular kind of payout or whatever. So in that circumstance, and you talked about the board's role in sort of being able to kind of inoculate the company, what should a board do in that circumstance, do you think?
The key is for the board, you don't want to take management completely out of the equation.
Right.
The key is for the board to leverage management, right? So the board has to be engaged. The advisors should be reporting to the board, right, not to management. And the advisors are supervising, chaperoning the management team, especially if private equity is on the scene as among the buyers. And so there you have the board's the eyes and ears of the board, and the board's giving direction. Right? The board is every important fork in the road, every strategic decision is coming. The board's not sitting there running the management presentation. It's not a special committee in the sense when you're negotiating directly across from management. But the board has organized this so that they are leveraging management, they're engaged, they're directing management. Sometimes it's a practical matter. Maybe you want to have a committee because it's just you can't get everybody on calls on a regular basis, so you have a smaller group. But that's the key, and that is a way. It's a win-win for everybody because management is engaged. You're getting all the upside that management has to offer as a party that has an informational advantage to help sell the company and get the best price. But you're also getting the supervision of the board, and that's where legal and financial advisors can really be leveraged as well.
Got it. Thanks. Hey, Anu, so Jim mentioned rollover requests. Maybe we take a moment on that. Could you talk a little bit about what are rollover requests and what are some of the best practices and protocols relating to insiders with significant stock holdings that are ripe for rollover requests in a transaction? So what's your advice? What are rollover requests and what's your advice for insiders in their role with respect to those?
So if there's an insider who has a meaningful stake in the company and there is a buyer who's buying the company, the buyer may want that this insider is a part of the future of the company after the transaction, and as a part of it may ask the insider to roll over, meaning not cash out their ownership, but instead transfer their ownership from the sell side to the buy side. So if you didn't roll over, let's say and it's a cash deal, every shareholder gets cash and they go away. In the event there is a rollover, and let's say there's an insider with a 10% stake, and it's a 50% rollover, then for half of their stake, 5%, they will get cash, and the other 5%, they switch from the seller to a buyer. So the buyer doesn't need to fund for that. And if you're doing a sources and uses, it'll show up on either side for the technicians on the call. But the way to think about it is it has three purposes. One is it aligns interest in terms of this insider, especially if they are following the path that Ethan was just describing, right? Where they are very motivated, they are enthused and energized about the business and its future in the hands of the buyer. So tying this to the earlier point on forecasts and things like that, it holds a little bit their feet to the fire because their interests are aligned because they're going to be on the other side executing on this forecast if they are a part of the management team. The other benefit this has is in reducing the check or financing that the buyer needs to come up with. Because again, the larger the insider's stake and larger the rollover, that's amount that you don't need to cash out. And I'd say, lastly, it's also, again, if you have an insider CEO management team, and if it is in the context of a take-private transaction, oftentimes this is sometimes the vision that the management team has, is that there is a particular strategy which is hard to execute in a public company format, and in a private company format you could do it. It also provides economic incentive to that management team. So there's multiple purposes that this rollover achieves.
Okay. And any particular advice for companies, for insiders in dealing with that situation?
So it's, in a public company situation, it's obviously pretty complex, right? Because you want to make sure that you are not self-dealing or doing anything of that type. And the focus is on making sure that in the event the company is going to pursue a transaction, you're maximizing value for the shareholders, so the shareholders who are exiting. So that's the reason that rollovers get a lot of scrutiny, because if you're both a buyer and a seller, and that's the colloquial way of describing a rollover, if you are that, then where is your head?
Right.
At every point of time, are you acting as a seller or are you acting as a buyer? And so that's the reason that, I won't repeat what Ethan said, in addition to kind of following that process, an important element of this is sequencing, is making sure that the negotiations around price of the deal is done before the terms of the rollover are negotiated.
That's great.
So that there is clarity
Now, sometimes
in sequencing and the decision making.
Sometimes, though, Anu, it's not. Sometimes there's a sliding scale, right? So the bidder's saying, a bid has to assume rollover because that's part of your equity financing for the transaction, and different bidders. I mean, this is where it gets really dangerous, right? So it would be an awful situation is where one bidder is able to assume that they know they can get a certain amount of rollover, and the other bidder's in the dark on that. And they're saying, well, I'm not going to bid so high because I don't know exactly if my sources and uses is going to include X billion dollars of equity financing out of the CEO. And so it's really important. The sequencing, I agree, can save the day, but it's also equal treatment is almost more important, right? So sometimes you need to accelerate the rollover point because all the bidders are saying, I can't really get out my final.
It needs to be a level playing field.
Yeah, so that the board can evaluate a level playing field.
But sometimes I'm saying you can't sequence it because sometimes the bidders will freeze up and say, I really can't give you my best and final price and agree because I got to know what's going on with the rollover first. And then the great thing would be to have the rolling over holder insider, be upfront with everybody. Now, what's interesting is, as a matter of law, just because the CEO has a fiduciary duty to the company in his capacity as CEO, he doesn't have that same duty necessarily as a shareholder to say, I'm going to roll over the same with everybody. He may really prefer working with certain buyers and have no interest in the philosophy and working with other buyers and co-investing with them. And that's his prerogative or her prerogative, but it will put more pressure on the process because it will put it further and further into entire fairness territory as the deal becomes more constrained in its ability to get the best price because the playing field's no longer level for everybody.
I just want to add one quick thing to this. So there's another bucket here that we haven't talked about, which is retention, right? So rollover is all about taking something that you've earned and taking it back from you, making you invest in a deal. It's often, almost always paired with a retention plan, and the size of that rollover versus the size of the retention plan are often actively under debate, all in terms of best practice after prices agreed. But, and this is a little bit of the job of the advisors, depending on the strength of your process, how much can you push somebody to put more into the retention bucket versus into the rollover bucket. And this is something that you see in lots of deals, not just PE deals or deals where insiders are going to go on and run the company. It's in founder-backed deals, and a lot of these growth company deals that we're seeing. There's a huge discussion around this, and it's real dollars for your client, the people that you're working with day to day.
It's pretty amazing. I agree with Tony. It's pretty amazing what goes on these days because what happened was in the startup M&A context, the traditional way of negotiating those deals was you put a number on the table and you say, this is our total number. And it'll have to be allocated between stay bonus pool and what we're going to pay for to the equity. And then there'd be a little push, but no, that's an awful record, right? And okay, that's okay when you're dealing with a $10, $20 million little private company with 5 VCs as the shareholders. But now these companies stay private longer. They have hundreds, thousands sometimes of shareholders, many of whom have relatives who are plaintiffs' lawyers, many of whom are family offices who get angry. And on top of that, there's big dollars. These are these are high profile deals now. And so that culture is going to have to change. And they're going to have to get to more of the public M&A approach that Anu described with the sequencing. And also, it's a very, because the employees are critical in that for those deals, really critical. And so you really want to get your stay bonus pool and your retention in line, but you can't do that without the equity holders come first. That's the board's duty, and it's culturally there's a lot of stress there.
Yeah, and a lot of scrutiny there, right? Yeah.
Well, and will be growing.
Yeah, and so look, this came in from the audience. They asked Ethan, sorry, you're on the hot seat here, to talk a little bit about management neutrality policies.
Oh, I think they're talking about basically, and this is really, to have a protocol up front. So you say to management, okay, are you willing to roll over with everybody, right? Are you willing, what are your terms, everybody? And also making sure management, there's basically a protocol to make sure they'll play by the rules. No offline conversations, no discussion of your own arrangements, making sure you're going to play by the level playing field. But sometimes you got to get them up front also on what their plans are for rollover. Will they roll over with everybody? This was very, like Michael Dell was a big thing. He said, I'll just talk to everybody, I'll be involved. So that kind of, getting that protocol, being transparent with the board, understanding the limitations on it, all of that's important to do up front.
Great. And another question before, if we get time to do the Fundless sponsor topic, we will, but let's talk about the legal and practical pros and cons of including a majority of disinterested stockholders as a closing condition. So, Ethan, you want to take it from the legal side, and then Tony maybe practical?
Sure. Just 2 seconds on the legal side, because Jim, I think, explained it really well. It's just that if you're in a situation where you have some kind of conflict, significant conflict, this is a way of being able to have the defendants able to obtain dismissal on the pleadings, right, without having to go through all of the discovery and evidence and a whole trial. Because if you have a good special committee process that approves the deal, and you have majority of the disinterested shareholders approving, then the courts will give you this presumption. So that's a home run from just a pure litigation perspective.
Yeah, but does it actually help to include it as a closing condition? Because
not only do you have to include it not only as a closing condition, but before substantive negotiations start, the buyer has to say, I'm only doing the deal if this is a condition.
Okay.
And then sometimes, interesting, I'm in a situation now where the target is anticipating that there's going to be a big rollover, so they're saying to the bidders, don't give us a proposal without saying it's going to be subject to majority of the disinterested shareholders. Okay. We know it's good for you because we want to be able to cleanse our own exposure.
Any practical considerations that maybe
I
go
think
the other way?
Practical considerations really fall out of the legal framework. It's pretty well established at this point. It's a rare buyer who doesn't accept the idea of the cleansing nature of the majority of the minority. I mean, assuming they're buying the whole company, that risk becomes theirs. The litigation is going to be theirs once they own the company. And so you really have to have somebody who wants to cast all caution aside and really just say, I want this deal to happen, to kind of force that issue. And I really rarely see it. What Ethan just said in terms of the upfront discussion about, look, this is better for all parties if you have this condition, is much more the common practice.
Look, there is execution risk with having a higher shareholder approval. Yeah. And as your controlling shareholder has more shares, that means
You've handed over authority over to the majority of the
Act as a
minority,
shareholder,
and
someone else can come and build
yeah.
up a stake and block the transaction. And
Right.
there have been situations where they go through entire fairness review, and the court has found that both the process and the price were fair.
Yeah.
So,
I mean, remember, right? If you have it's very hard to have damages ultimately in entire fairness if the price was a fair price.
Right.
Now, the risk is you have a bunch of non-economic experts, judges with submissions from valuation experts, and you never know how that's going to come out.
Right.
But if you, my point is though, there is some risk, there's execution risk, and as it gets smaller, and there's this whole, we could have a whole program about deal activism, where guys come in to try and block the deal just to get a bump, and it does make it accessible to that.
Right.
Interestingly, before the Delaware courts made it a true safe harbor by having these two prongs, special committee and majority minority, lots of deals were done with only a special committee. And there was not this
extra.
Yeah, there was a lot of belief that let's just blow through it. And I even published a study at one point of the settlement amounts, and there was not a meaningful difference in settlement amount with the plaintiffs if you had majority and minority didn't.
Got it.
And so it was, I think, but now I agree with Tony that the idea of getting a total free pass is just so attractive that.
and people feel like they're doing something wrong if they don't do it.
Got it. So let me pause for a second. For folks looking for CLE credit, your verification code is 11925. Okay, you should still stay tuned because we've got a little bit more to go. Let me just ask, if I could, briefly about fundless sponsors. What are fundless sponsors? How do we get here? And what are the key issues associated with fundless sponsors? Tony, do you want to talk a little bit about that?
Yeah, well, a fundless sponsor is a buyer who does not have a dedicated and committed fund. They're going to go and sign up outside investors to make this investment upon getting agreement with you. It's, there's always been some part of the market, generally the smaller end of the market, where this existed, but we've increasingly had folks who are doing much bigger deals on a fundless basis, essentially based on their reputation. So it's an issue that comes up. You would treat it the same way as you would for a smaller deal and say, well, is the money good, right? It's all kind of, the equity financing is, more suspect in that situation than debt financing or any other type of financing, and you have an obligation as a company and the advisors to deliver certainty of closing. And so a lot of the work in these situations revolves around judgments around the ability of the buyer to get those funds.
Right. And Anu, any thoughts on that as well?
In some ways, it sounds as an oxymoron, right? Fundless sponsor. The whole purpose of the buyer is supposed to be that they have money. And I think it has evolved that way really because of how much capital there is to deploy and how big the private capital markets have become. So when people are going to raise their fund, earlier the fund sizes were smaller, and today people are able to raise $5-10 billion funds very quickly, and these are oversubscribed. And so then the thought is, why should I lock that money in? And instead I should be able to take a look at what is this opportunity and decide on an opportunity basis on whether to put money in or not. So from an investor perspective, having the option to be associated with some of these fundless sponsors and being the funding behind it is actually quite interesting. From the fundless sponsors perspective, again, you don't have to deal with managing all this money and having the time pressure of deploying it and things like that. You can go find the idea and then go to these people and get the money. So it kind of makes sense for them as well. So the party on whom all the risk goes in this is really all of us,
the target, right? Yes.
Is when you're representing, the target company, the target board, the target advisors. Because now the way you have to diligence somebody, as Tony just said, it's a lot based on the reputation of the sponsor, the fundless sponsor. And so you're taking a judgment call on that, but you also that's not enough. You have to do due diligence on who's behind it. Is it all the money going to come from these people? Is it going to be a combination of funded sponsors and fundless sponsors? Who are they? Are these identified parties? What due diligence can you do on it ahead of time? Because you don't want to surprise the board at the 11th hour, which is how the original version kind of happened, is when someone says, okay, I'm putting together the money. Okay, I now got it. Here is it. And here is the list. And you look at that list, and these are names that you don't recognize. So I think it has now evolved with a few deals to a point where we'll now have a questionnaire that we'll give to people and say, here is the information that we need from the parties that you think are going to show up in this deal.
It's tough.
And we need this. It's not hours, it's days, ideally a couple of weeks, if possible. So there's a tension between exactly when it is that you'll get it. There's not only do we need to know who is the money coming from, basic information on those people, but also, depending on how competitive the process is, it would be good to get the funded sponsors on the hook. So get them on the hook for the reverse break fee. Get them on the hook to go find the money in the event the fundless guys don't post.
Right.
And again, your ability to do that is just negotiating leverage, right, back and forth. So that is all technology that has really evolved, I'd say, in the last couple of years.
I just to add that the most important point is this can't happen in a few hours.
Right.
And there's a tradition in private equity of having the equity commitment letters and the final touches on the sources really being put together, in a very condensed period close to signing. When you have a lead sponsor who everybody knows has a huge fund and everything's going to, and you're like, well, they'll take care of it. But when you don't have that now with these, with these less brand names and all this coming in, it could lead to a very stressful process in the boardroom with a lot of pressure being put on the advisors. Well, are these guys good for the money? And they're not. We have to announce this. We're all done. And so, and you have to try and plan for this in advance. And as Anu says, you got to make sure that you have right people on the hook with the right undertakings. And sometimes you have to get some unorthodox undertakings. Like I've done deals where we took some of the equity sponsors and we said, you have to syndicate down your commitment within a certain period to creditworthy sponsors because you have too much, right? You only have 1.2 billion of assets, and you're in a $900 million commitment, and I don't even know how that's too much. So I want things, and so you have to do some things which you wouldn't have done in the old days.
So who takes the lead in doing due diligence in this area? Is it your outside investment banker? I mean, what role does the company play here? I mean, who really takes the lead in drilling down on
the advisors?
Situation?
The advisors, the financial and legal advisors.
Yeah. Okay.
So, it's not fun.
Yeah,
that stuff. It's because it's just it's just getting information out of people who are very proud of themselves.
Right.
You would ask me for my balance sheet, or come on, I'm the and so it can be stressful.
Great. Well, I think we're getting close to the end here, but any final closing thoughts you want to share?
I would just say it's a pretty dynamic situation. I think Tony, that was probably the key word. Is you got clients moving in all sorts of directions, and it puts pressure on all of these issues because lots of dry powder out there for these LBOs, lots of creativity on financing, including rollovers, and then lots of clients moving. Industrial companies are becoming tech companies, and everybody's got these 5 initiatives that Anu said, and So it makes it for, it's not a sleepy process these days for M&A.
Got it. All right. Well, with that, we'll let you have the last word there, Ethan. Thank you, all of you, for being on the panel today. I found this really fascinating. I hope our audience did as well. And thank you all for joining us. And until next time, this has been Governance Watch.
Thanks.
Thank you.
Thanks, Paul.
Thank you.